Hello and welcome back to MonsterInvest. I'm your host, Daniel. I want you to close your eyes for a moment. Imagine a bridge, but not just any bridge. I want you to picture the most scientifically advanced suspension bridge ever conceived by human minds. The architects didn't just draw this on a napkin. They spent years simulating every possible scenario. They fed centuries of weather data into a supercomputer. They knew exactly how the wind curls through the valley in November. They knew the precise weight of the average sedan versus the average truck. They calculated the thermal expansion of the steel to the micrometer. Their goal was noble: efficiency. They wanted to build a bridge that wasted nothing. No excess concrete, no redundant cables, no wasted budget. They tightened every bolt to the exact tension required by their models. It was a masterpiece of optimization. It was lean, it was beautiful. On paper, it was perfect. The engineers won awards. They patted themselves on the back for creating a structure that did exactly what it needed to do, without an ounce of fat. But then the unthinkable happened. A storm rolled in, but not a normal storm. This was a black swan event, a freak combination of high pressure and wind direction that hadn't appeared in the data for the last 500 years. The wind hit the bridge at an angle of 42 degrees, causing a harmonic resonance that the computer models hadn't accounted for because, statistically, it was impossible. Because the bridge was so perfectly optimized for the known world, it had zero capacity for the unknown world. There was no slack, there was no redundancy. And so, under stress it wasn't perfectly tuned for, the masterpiece didn't just crack. It snapped. It collapsed into the river below, taking the engineer's reputation with it. This is the hidden danger of over-optimization. And while we rarely see physical bridges collapse today, because civil engineers understand the value of safety margins, I see financial bridges collapsing every single day. I see portfolios, constructed by brilliant people, shattering into pieces because they were built for a world that no longer exists. Today, we are going deep. We are going to explore the seduction of the perfect portfolio. We are going to uncover why trying to squeeze every last percentage point of return out of your data is not the path to wealth, but the path to fragility. The topic for this episode is the real risk of over-optimization when perfecting your portfolio backfires. Let's start by addressing the elephant in the room. We all love data. We live in an age of information. If you want to know how the S&P 500 performed on rainy Tuesdays in 1974, you can find that out in seconds. And because we have this data, we have an uncontrollable urge to use it. We look at the past and we say, if I had just tweaked my portfolio like this, if I had held 18% in gold instead of 10%, if I had bought tech stocks only in November. We start to build a strategy that fits the past perfectly. It feels like we are discovering a secret law of the universe, but we aren't. We are committing a statistical sin called curve fitting. To explain this, I want to tell you the story of a man named Alex. Alex isn't a gambler. He's not someone who throws money at meme stocks. Alex is an engineer. He is methodical. He respects logic. When Alex decided to manage his own wealth, he didn't listen to rumors. He downloaded the data. He spent 6 months building a backtesting engine. He wanted to find the holy grail. He tested thousands of combinations. At first, he found a strategy that returned 10% a year. Not good enough, he thought. He tweaked the parameters. He added a rule: sell if volatility spikes. Now it returned 12%. He kept going. What if I leveraged the bond portion by 2x? Now it returned 15%. What if I remove the energy sector entirely because it underperformed in the last decade? Suddenly the numbers screamed at him. 22% annualized returns, max drawdown of only 5%. Alex looked at his screen and felt a rush of dopamine. The equity curve on his monitor wasn't jagged. It was a smooth, beautiful line going up and to the right. It looked like an escalator to heaven. He felt like he had solved the market. He felt safe. He took his life savings, money meant for his kids' college, money meant for his retirement, and he poured it into the algorithm. For the first 18 months, Alex felt like a god. While his friends were sweating over market dips, Alex's optimized portfolio was printing money. He would check his phone at dinner parties, seeing those green numbers, and smile. He told his friends, "You just need to trust the data. Math doesn't lie." But math doesn't lie about the past. It makes no promises about the future. The turning point came out of nowhere. The market regime shifted. Let's say Alex's model relied heavily on the relationship between interest rates and tech stocks. For the last 20 years, when rates went down, tech went up. His entire optimization was built on this seesaw mechanic. But then inflation roared back, something the market hadn't seen in 40 years. The Federal Reserve started hiking rates aggressively. In Alex's model, this was supposed to be manageable, but he hadn't accounted for the speed. The correlation between his safe assets and his risky assets suddenly went to 1. Everything fell together. The semiconductor stocks he was leveraged in, they crashed. The long-term bonds he used as a hedge, they crashed even harder. Alex watched his screen in horror. The smooth escalator line turned into a cliff. He kept waiting for the mean reversion that his data promised. He kept telling himself, statistically, this cannot happen. But markets can remain irrational longer than you can remain solvent. Within 3 weeks, Alex lost 40% of his portfolio. The perfect machine had broken. Alex's mistake wasn't that he wasn't smart, it was that he was too precise. He had optimized his portfolio for a specific type of weather, and when the season changed, he froze to death. Now you might be thinking, Daniel, that's just a story about a guy who used too much leverage. So let's move from fiction to cold, hard reality. Let's talk about a disaster that hit millions of regular people just recently. Let's talk about the year 2022. For decades, financial advisors have sold us the 60-40 portfolio. You put 60% of your money in stocks for growth and 40% in government bonds for safety. The theory of the optimization was simple. When stocks crash, investors get scared and run to bonds. So if stocks go down 20%, your bonds might go up 10%, cushioning the blow. It was the perfect balance. It was the default setting for every retirement fund in America. It worked beautifully until it didn't. In 2022, we saw the breakdown of this perfect correlation. Because inflation was the enemy, central banks had to crush the economy. Stocks fell because earnings were threatened. But bonds also fell, historically hard, because interest rates were rising. If you were optimized for the negative correlation between stocks and bonds, you got crushed. There was nowhere to hide. The safe part of your portfolio became the risky part. Millions of retirees opened their statements and saw that their conservative portfolio had lost 20% of its value in a year. Why? Because the 60-40 split was optimized for a low-inflation world. It was a fair-weather bridge. So this brings us to the core philosophical question. Why do we do this? Why do we obsess over tweaking our portfolios to perfection? It comes down to psychology. It comes down to our fear of uncertainty. The real world is messy. It is chaotic. Wars start overnight. Pandemics shut down the globe. Technologies disrupt industries in a heartbeat. That chaos is terrifying. A spreadsheet, on the other hand, is orderly. Rows and columns, clean percentages. It gives us the illusion of control. We think, if I can just find the right combination of numbers, I can shield myself from the chaos. But here is the counterintuitive truth, and if you take only one thing from this episode, let it be this. To survive in a chaotic world, you must be willing to be inefficient. Let me say that again. You must be willing to be inefficient. Let's look at biology again. It is the ultimate teacher. Mother Nature is not efficient, she is redundant. You have 2 lungs, you have 2 kidneys, you have layers of fat that you don't need for your daily walk to the office. From an optimization standpoint, having 2 kidneys is a waste of energy. It's dead capital. A modern consultant would look at the human body and say, let's cut 1 kidney, it's hurting our ROI. But nature knows that systems fail. Nature optimizes for survival, not efficiency. If 1 kidney fails, the redundancy saves your life. That inefficiency is actually your insurance policy. So what does a biological portfolio look like? How do we stop being like Alex? It starts by accepting something uncomfortable, cash drag. You see, an optimized portfolio hates cash because inflation eats it, but a robust portfolio loves cash. Cash is the option to buy when everything else is on fire. It is the oxygen tank you carry even when you aren't underwater. Yes, it lowers your returns in a bull market. That is the price of admission for survival. Next, you need to rethink diversification. Don't just own 5 different tech companies and call it diversified. That is fake safety. You need to own things that hate each other. Own stocks for growth. Own bonds for deflation. Own gold for when people lose faith in paper money. Own energy or commodities for when inflation spikes. Here is the painful part. In a robust portfolio, something will always be losing money. You will look at your gold and say, why do I own this rock? It's done nothing for 5 years. You will look at your cash and say, I'm losing to inflation. You will feel regret. You will feel suboptimal. But then the storm comes. The tech stocks crash. The bonds fail. And suddenly that useless gold spikes 30%. That dead cash allows you to buy the bottom of the market. The parts of your portfolio that looked like dead weight suddenly become the life rafts that save your future. And finally, you need to have a loose fit. Stop trying to rebalance to the exact decimal point. Stop trying to time the market perfectly. Use broad strokes. Be roughly right rather than precisely wrong. The legendary investor Benjamin Graham called this the margin of safety. It is the gap between what you think will happen and what could happen. The more optimized you are, the smaller your margin of safety becomes. So as we bring this episode to a close, I want to leave you with a challenge. Tonight, look at your investments. Ask yourself, am I Alex? Are you betting on a specific future? Are you assuming that the next 10 years will look like the last 10? Are you leveraged to the hilt because a backtest told you it was safe? If the answer is yes, take a breath. It might be time to de-optimize. It might be time to sell some of the winners. It might be time to buy some insurance assets that look ugly right now. Because the goal of investing is not to have the highest number on the scoreboard at the end of the year. The goal is to never get wiped out. The goal is to stay in the game long enough for compound interest to work its magic. Don't build a glass castle, build a fortress. It might not be as pretty, but it will keep you safe when the wolves come. Thank you so much for listening to this deep dive. I hope this episode sparked some new thoughts on how you view risk and reward. If you found value in this story, if it made you think, please do me a huge favor. Smash that like button, hit subscribe, and ring the notification bell. It helps the algorithm find more investors like you who want the truth, not just the hype. This has been Daniel with Monster Invest. Stay humble, stay robust, and I'll see you in the next episode.